Welcome to the Tesla Daily News Podcast. I'm glad you're here. Today is April 5th, 2026. We're breaking down the biggest Tesla headlines that could actually move the stock: the weak first quarter delivery print, the record inventory build, energy storage coming in light, fresh analyst positioning into earnings, Supercharger expansion signals, and the way geopolitics is starting to show up as a real risk factor for Tesla and other US tech brands. Let's start with a big one. Story 1. Tesla's first quarter deliveries missed expectations, and the market punished it. Tesla just posted first quarter 2026 vehicle deliveries of 358,023. That's up about 6.3% year over year, but down sharply versus the fourth quarter of 2025, when Tesla delivered 418,227. The hook here is simple. Tesla is still growing year over year, but not fast enough for a company priced like a high-growth platform. Context: deliveries are the cleanest near-term demand signal Tesla gives investors. When that number misses the street, sentiment tends to swing quickly because it raises questions about pricing power, demand elasticity, and margin trajectory. Details: Bloomberg's average analyst estimate was roughly 372,160 deliveries, so Tesla came in under that. And the mix matters. The Model 3 and Model Y made up the vast majority at 341,893 units. That suggests the growth engine remains the high-volume models, while the rest of the lineup is a smaller slice. Impact: Tesla fell about 5.4% on the day of the release, closing around $360.59, a move that wiped roughly $82 billion of market cap in a single session. That's the market saying, we're not comfortable paying up unless the core auto business stabilizes. Takeaway: if you're a shareholder, you should treat this quarter as a stress test of Tesla's demand and pricing narrative, and listen closely on the next earnings call for commentary on incentives, order rates, and whether the company is intentionally prioritizing production for future programs. Story 2. A record production versus delivery gap is building inventory, and that's the bigger red flag. Here's the hook. Tesla produced far more cars than it delivered, and the gap is the largest in company history. Context: Tesla historically managed production tightly against demand, keeping inventories lean. A widening gap can mean one of two things: deliberate pipeline build for logistics and exports, or demand is softer than production assumptions. Details: Tesla produced 408,386 vehicles in the quarter, but delivered 358,023. That's a difference of a little over 50,000 vehicles. Multiple outlets noted this is Tesla's biggest production minus deliveries spread ever, beating the prior record from the first quarter of 2024. Impact: inventory tends to pressure gross margin in two ways. First, it raises the probability of price cuts or financing incentives to clear stock. Second, it can imply underutilized factories later if Tesla slows lines to rebalance. For Tesla valuation, this is not just a deliveries miss story. It's a working capital and margin risk story. Takeaway: watch Tesla's next margin and cash flow print closely. Inventory build isn't automatically fatal, but it becomes a problem if it persists into a second quarter and forces deeper discounting. Story 3. Energy storage deployments also came in light, and that matters more than many traders admit. Hook: Tesla's energy business didn't provide the offset investors were hoping for. Context: in a world where EV margins get compressed, Tesla bulls increasingly lean on energy storage as the stabilizer, a business that could scale with strong gross margins and long-duration demand from utilities. Details: Tesla reported 8.8 gigawatt-hours of energy storage deployments in the quarter. The prior quarter, fourth quarter 2025, was 14.2 gigawatt-hours. That's a big sequential step down. Impact: when both automotive deliveries and energy deployments miss expectations in the same update, it narrows the number of easy bullish explanations. Analysts can still argue that Tesla is in an investment phase, but the near-term narrative becomes harder. Takeaway: for investors, energy is no longer a side quest, it's part of the core thesis. If deployments remain volatile, the market will likely demand stronger proof that autonomy and AI can compensate. Story 4. Dan Ives stays bullish and frames Tesla as an AI and robotics platform, not just an automaker. Hook: one of Tesla's loudest Wall Street bulls is not blinking. Context: Tesla's valuation has long been defended by optionality, robotics, full self-driving, and humanoid robots, rather than by near-term car earnings alone. The market's willingness to pay that premium depends on whether investors believe the timeline and execution risk are manageable. Details: Wedbush analyst Dan Ives reiterated a buy rating and kept a $600 price target, which implies roughly 65% upside from around $360. He acknowledged the quarter was underwhelming, but argued it was not a shock given broader EV softness and Tesla's strategic pivot toward AI. He also pointed to China as a relative bright spot, noting reports of a roughly 35% year-over-year jump in Tesla deliveries there in the first couple of months of 2026. Impact. Bullish targets like this can stabilize sentiment after a miss, but they also raise expectations for upcoming catalysts. If Tesla fails to show progress on autonomy, or if auto margins keep sliding, high targets can flip from support to pressure. Takeaway. The market is increasingly bifurcated. The auto fundamentals crowd is focused on demand and inventory. The platform optionality crowd is focused on robotics, AI infrastructure, and Optimus. Earnings will be about whether Tesla can credibly serve both narratives at once. Story 5. Investors are already looking at April 22nd as the real decision point. Hook. The delivery report moved the stock, but the earnings call may reset the entire quarter. Context. Tesla's stock often trades more on forward guidance and narrative than on last quarter numbers. When deliveries disappoint, the next question becomes, will management guide to stabilization or double down on longer-term AI bets? Details. Consensus expectations cited in coverage point to about $22.97 billion in sales and about 40 cents normalized earnings per share for the quarter, with revisions trending down in recent weeks. Impact. If Tesla signals heavier incentives, weaker pricing, or slower growth, the multiple can compress. On the other hand, clearer timelines for autonomy rollout, robotaxi commercialization, or meaningful Optimus production milestones can reinflate the story, even if near-term auto is choppy. Takeaway. If you're trading Tesla, the setup into earnings is about volatility. If you're investing, the question is whether Tesla's next 2 years look more like an auto cycle or the start of a software and robotics monetization curve. Story 6. Tesla's Supercharger network just hit 80,000 fast charging stalls, and that's a quiet competitive moat. Hook. Amid all the noise on deliveries, Tesla's charging footprint keeps scaling. Context. The charging network is one of Tesla's strongest structural advantages. It supports Tesla vehicle demand, creates potential recurring revenue from non-Tesla charging, and strengthens the brand's ecosystem. Details. Tesla opened its 80,000th fast charging stall globally in Saint-Saturnin in France. That site reportedly expanded by 28 stalls and now has 48 charging ports, plus solar canopies and on-site restrooms. Impact. This isn't likely to move the stock on its own, but it matters for long-term retention and for the Energy Plus software ecosystem case. Better charging access reduces one of the top friction points for EV adoption. Takeaway. Don't ignore infrastructure. In a pricing war, moats like charging reliability can do the work that price cuts used to do. Story 7. Geopolitics is creeping into the Tesla risk stack, and investors should price it like a tail risk. Hook. Tesla has been named in reports as a potential target amid escalating Middle East tensions. Context. Markets don't need Tesla to be directly impacted for the stock to react. Higher oil prices can affect inflation and rates, risk-off sentiment can hit high multiple growth stocks, and any threat to U.S. tech brands can amplify volatility. Details. Coverage around the conflict referenced Iranian Revolutionary Guard warnings naming U.S. companies, including Tesla, among potential targets in the region. Impact. The most immediate market channel is macro oil spikes and risk-off flows. For Tesla specifically, it also raises questions about operational exposure, supplier and logistics disruption, and cyber or infrastructure risks in allied regions. Takeaway. Treat this as a volatility amplifier, not a base case earnings driver. But in a market already nervous about growth and valuation, tail risks matter more than usual. Alright, let's wrap it up. Today's themes were clear. Deliveries missed, inventory built to a record gap, energy storage came in light, and the stock sold off hard. But key polls are still framing Tesla as an AI and robotics platform heading into a major earnings moment on April 22nd. For tomorrow, watch 2 things. First, any new pricing or incentive signals in major markets like the US, Europe, and China. And second, any incremental news on autonomy timelines, because right now, the market is asking Tesla to prove the next growth engine while the current one is wobbling. If you found this helpful, subscribe to the Tesla Daily News podcast for a data-driven update every day, and follow us for the next episode as we track the run-up into earnings.